Right, guys, hi. So this is chapter 3. I mean, I know we've done this in class, but because we're creating a series for the program anyway, I'm going to record it anyway for you to get a chance to go over it if you wish. So chapter 3. So what are we talking about here? We're talking about intangibles. I suppose there is a way, IAS 36 impairment provisions and so M before N, so 36 and then 38. And in the middle you have provisions and contingent liabilities. That's the way I remember the numbers, but you don't need to remember the numbers. You don't. You just need to sort of understand the content, if you like, of the standard. Right, so the aim of this chapter, of course, is to really discuss this business of internally generated intangibles and purchased intangibles. So of course, the very idea that you can even buy an intangible. So, for example, a patent, if you like, or a license, gives it some measurement reliability, doesn't it? Straight away. So it means that we should be able to recognize it because we've just paid for this thing, and therefore it has a very clear, separable valuation that we've been able to sort of detach from wherever it came from and acquire, and therefore use to generate economic benefit. We can see economic benefit flowing. That's the purpose, right? The whole idea. In fact, the truth is even that very fundamental purchase price is the present value of future economic benefit coming into the organization as a result of that purchase. So we will discuss very quickly. We will also look at the accounting treatment of internally generated and purchased intangibles. Discuss this business of goodwill and other intangibles. I'm quite happy that we looked at the later chapters first on goodwill, which allows us to kind of understand straight away how goodwill is achieved via working 3. If you like, that understanding of the difference between our consideration and the non-controlling interest, that fair value versus the net assets of the subsidiary require goodwill. So we can see the intangibility there of that asset, the additional money you have paid, or whatever additional consideration, I should say. And the criteria. The criteria for initial recognition, of course, is a step up, of course, from when I say a step up, you must, of course, satisfy the recognition criteria for assets as they are, but then we must also include or recognize that additional recognition based on the fact that we're dealing with intangibles, right? Intangibles. It's a secondary issue here. Yeah, looking at the initial measurement, and of course, like all standards, initial recognition is important. Can we measure it? And then, of course, there's the debate about subsequent treatment of these things, and of course, impairment in relation to goodwill, and just dealing with those requirements. And then I think we finish off on research and expenditure, research and development, research expenditure and development expenditure, I believe so, at IAS 38. Yes, and accounting for that research and development. I think sometimes writing these things out of context helps. Pirate is your guide. Technical feasibility. You have the funds to complete it. We are sure it will bring economic benefit. Those are your drivers, really, to guide us as to know where we're starting off with research costs, debit expense, of course. And the moment you get to this point where, like, listen, we believe now that this can now yield economic benefit, we're like, okay, great stuff. Yeah, please recognize that economic benefit, or capitalize that, should I say. Capitalize that economic benefit. Right. So here are some intangibles. An intangible is an identifiable non-monetary asset without physical substance. Includes items such as licenses and of course patents and brand names and trademarks. So intangibles vary, if you like, in how they present themselves. Some are for a period of time, and of course some end up being almost like lifelong type, if you like, assets that we need to be cautious about how we present them or recognize them. So we might have to accept that they'll be over a lifetime, and some will have a period of time, so we can then amortize over the period of time versus looking at the value at the end of every year and then impairing as we go along. So it's just that sort of awareness. So typically for an asset, for an intangible ultimately to be identifiable, it must fall into the normal definition. So this idea of separable, this is what I was saying earlier on. The fact that you can actually buy a license means that it's individual, it's unique to itself, it's separable, it's a contract, a piece of paper that gives you the right, if you like, to acquire income, if you like, and to work with it. So it is separable. It can be bought and sold separately from the rest of the business, and it arises from legal contractual rights that will arise as part of, if you like, purchasing an entire company. So really, again, like I say, the key point here is it must meet the normal definition of an asset. So the standard itself gives us the definitions it wants for assets. So it is controlled by the entity as a result of past events and future economic, and it's a resource for which future economic benefit is expected to flow, or I suppose potentially savings. You can have cost savings. But the key point here is that this thing, any asset we buy, the whole idea is that we will see potential economic benefits flowing into the organization as a result of the acquisition of this asset. Right. Again, yes, of course, to recognize it. I think really the question of recognition really comes from this question of reliability, if you like, this question of faithful representation. Can we actually measure it reliably? And and typically the best, I guess, form of reliable measurement is if you've actually bought something, you've paid for it. So that's evidence of good, clear reliability, at least. So if these criteria are met, the assets should be recognized. Going back again to the cost concept, really that has always been within IAS 1. Nothing's changed here. Always have that concept, cost concept, recognized at cost. So again, of course, if an intangible is purchased separately, such as a license, a patent, a brand name, it should be recognized initially at cost. Now, of course, the standard in itself very much, allows you, kind of similar to under IAS 16 PPE, to kind of, this is policy, isn't it? You do have the cost model and the revaluation model. We will see the leaning, of course, is towards the cost model. In practice, people might argue for the revaluation model in the reality of life. But the fact here is that there is some degree of, again, IAS 16 and what we have always known about the cost model. There is a stability about keeping things at cost. It is less likely to be manipulated, and we know what that value is when we have it in there at cost. Right? There's no confusion, so to speak, about that. The problem, of course, with valuation is that we have to keep it regular, and those are the issues. So really, the standard leans, due to all that confusion and that potential manipulation or potential room for creative counting, and also to enable good comparison and easy comparison between different, to reduce the volatility of comparison, so to speak. It's the cost model is favored. So what is the cost model? It's what it is. What did you buy the thing for? And then, of course, like all assets, you will amortize over the life of the asset. And of course, impairment is also a standard. We'll see it in the next chapter. But typically, any evidence of impairment in general, we also have to apply. So depreciation plus impairment, if you have any. And that's typically the common thing. Amortization works exactly as depreciation. You're pretty much amortizing over the economic life with this annual expense being shown in profit and loss each year. And typically, again, like I say, you must look at the asset itself. So if we're dealing with a patent that has a fixed life, if you like, before it is open to everyone to be able to use, we will amortize over that life, typically using a straight line method with a zero residual value. And that's kind of the angle that we take with this, right? As you would expect us to do. And well, if you do have an intangible asset, so for example, you can have a brand, if you like, or copyright. It's difficult. You can't have a lifer here, so you have an indefinite useful life. So you don't amortize. What you literally do is every single year you test for impairment, if you like to see what's going on with the asset. I mean, I'm still holding it at cost, by the way. I'm just testing for impairment as I go along, if you like. Um, that's the key point. I'm just testing for impairment every year on year. So I do have this. Okay, yeah, so that's 10 minutes. I think it's good to keep them short. I'll keep it short at 10 minutes so you can at least see these little packages you can always keep coming back to, and as opposed to sitting there for a very long time. Okay, great stuff. So we'll continue in the next video with the revaluation model.